Welcome to this explainer. It's wild to think about, but global finance is basically running on two completely distinct economic engines. Today, we're going to unpack the structural divide between conventional and Islamic financial markets. We'll map out exactly how these parallel systems are architected, from the ground up, how they handle risk, and how they navigate our modern digital era. It's a deep dive that's definitely going to change how you look at global capital. Okay, let's dive into this. Here is our step-by-step roadmap. We'll be covering the structural divide, the engines of capital generation, and the difference between debt and ownership instruments. Then we'll move on to governance, performance, and risk, and wrap things up with future horizons. Section 1, the financial structural divide. To truly understand these markets, we have to look all the way down at their foundational DNA. When you put these two systems side by side, the difference in what actually motivates them is staggering. Think about the conventional market for a second. It's mostly interest and debt-based. It's designed around profit maximization and risk shifting, which usually means the borrower takes on the burden, regardless of how the business actually performs. But the Islamic market? It's strictly governed by Sharia principles. It mandates asset-based financing and risk sharing, so money is tied directly to real-world economic activity. To operate here, you absolutely have to avoid riba, which is usury or interest, gara, meaning excessive uncertainty, and maisir, or speculation. Basically, one system focuses purely on the flexibility of profit, while the other binds every single transaction to tangible, ethical trade. For an investor, that completely changes where your money physically goes. Section 2. Engines of capital generation. So now that we know their DNA, let's look under the hood. How do these vastly different systems actually generate wealth? Now, what's really interesting here is the flow of capital. Take a look at the conventional engine. It uses money to make money directly via interest rates and debt. It's highly efficient, sure, but it can easily become totally disconnected from real-world trade. Now look at the Islamic engine. You can't just lend money for interest. That's a no-go. To generate a shared profit, your capital has to be combined with a valid Sharia contract, like an actual trade or a tangible asset lease, which then fuels real economic activity. As experts point out, the Islamic money market isn't just some interest-free version of the conventional one. It operates on a totally unique legal and ethical framework. And that brings us to an absolutely crucial point: how this structural DNA dictates risk. In conventional finance, the core mechanism is a loan, so the risk is entirely risk-shifting, placed squarely on the shoulders of the borrower. In Islamic finance, the baseline contracts are built on risk sharing, meaning profit is legally tied to taking a risk and actually owning an asset. But there's a fascinating nuance here. Research by Sobel actually notes that while Islamic banking is ideally built on participation, intense market competition sometimes pressures these banks into offering fixed return products that kind of mimic conventional interest rates. That tension between theoretical authenticity and real-world market competition is a huge defining challenge for them. Section 3. Instruments, debt versus ownership. How do these theoretical engines translate into actual financial parts we can use? If you map out these financial instruments, a major structural shift emerges right away. A shift from debt straight to ownership. Take long-term capital, for instance. A conventional bond is simply a debt obligation, right? You lend money, you get fixed interest back. But the Islamic equivalent, a suku, is fundamentally different. It represents actual equity interest, a beneficial ownership in an underlying asset, business, or project. As a suku holder, your returns come from actual cash flows, like rental income or trading profit, never from fixed interest. And this brilliantly illustrates what happens when you want to take ownership in these Islamic equities. Global stocks have to survive this rigorous two-stage filtration funnel. The first filter is qualitative. It just automatically strips out companies involved in gambling, alcohol, conventional financial services, you name it. Then, the second filter is quantitative. It meticulously examines a company's financial ratios to make sure interest-bearing debt and non-halal income stay below very strict thresholds. Researchers have pointed out this is incredibly similar to modern ESG investing. It basically gives you a built-in risk control function by inherently weeding out highly leveraged, debt-heavy firms. Section 4. Governance and dual compliance. With such complex asset-backed instruments, how are these markets actually kept in check? Well, it's a delicate balancing act. While a conventional bank operates under standard financial law to ensure stability, Islamic finance requires a mandatory dual compliance architecture. Not only do these institutions have to pass the exact same rigorous financial laws as conventional banks, but they also have a second, towering layer on top: Sharia governance.
Every single product, contract, and operation has to be independently audited by Sharia experts. Now, this builds incredible transparency for investors, for sure, but it also creates a bit of a bottleneck, as this double layer of approval can sometimes slow down innovation cycles. But even within this dual compliance world, the regulatory models aren't identical, and they drive divergent market strengths. Look at Malaysia and Saudi Arabia, two absolute giants in this space. Malaysia uses a highly centralized model. This centralization acts as a huge catalyst, driving consistency and rapid product innovation, which has made Malaysia a global leader in sukuk issuance. On the flip side, Saudi Arabia utilizes a decentralized model that relies a lot more on individual institutional boards. While standardizing rules might take a bit longer there, their market is incredibly powerful, driven by sheer volume and the sweeping initiatives of Vision 2030.
Section 5. Performance, risk, and stability. We've explored the rules, but now let's answer the ultimate investor question. How do these engines actually perform on the open road? So the really crucial takeaway here is that rigorous ethical constraints do not mean sacrificing performance. Studies comparing indices like Pakistan's Islamic KMI 30 against the conventional KSE 30 show that Islamic indices often yield higher returns with similar volatility. Plus, if you're building a portfolio, Islamic indices offer massive diversification power. Because they don't move in perfect sync with conventional markets, they help minimize your overall risk. By filtering out highly speculative and leveraged firms through that two-stage funnel we looked at earlier, Islamic multi-asset portfolios often achieve equal or even superior risk-return optimization.
Which leads to a really fascinating divergence in how these markets absorb risk. Conventional markets tend to panic over interest rate hikes. When central banks raise rates, borrowing costs soar, bond values drop, and investors flee. But Islamic markets practically bypass these monetary cycles altogether. Because interest is strictly prohibited, these markets are legally divorced from those interest rate roller coasters. Instead, they're tied directly to real sector indicators, things like industrial production, exchange rates, and actual GDP growth. You are binding your capital to the real economy. Now, I really want to highlight this massive number, plus 3.6. According to recent research by Miro analyzing data from 2020 to 2024, when Islamic banks integrate digital fintech, they see their Z-scores, which is a key measure of financial stability, rocket up by 3.6 points. And at the exact same time, their non-performing loan ratios actually drop. Fintech essentially supercharges the inherent stability of their asset-backed structures. But, of course, there's a catch. We call it the digital dilemma. Conventional banks are entirely driven by profit maximization, so they adopted digital tools way faster, gaining rapid efficiency. Islamic banks, constrained by those compliance checks we talked about, have slower adoption rates. So you see this clear trade-off. Conventional banks focus on speed and profitability, while Islamic banks move a little slower but gain incredible resilience and stability in the process. Section 6. Challenges and Future Horizons. Let's see how all of this builds towards the future of global market architectures. For the Islamic capital market to really expand globally, it's got to navigate 6 systemic roadblocks. First off, there's a real scarcity of short-term liquidity. Then there's the ongoing tension of balancing authentic compliance while trying to compete with complex conventional products. Add to that a fragmented global standardization and a lingering lack of public awareness. Finally, there's the risk of falling behind in AI implementation, all coupled with a restricted market size that limits diversification from massive asset managers. But there is a clear strategic roadmap forward. To build a highly competitive market, institutions need to deepen liquidity by developing more short-term commercial papers. They really need to align with ESG frameworks, leveraging their inherent ethical limits to pioneer green sukuk and sustainable products. On top of that, they must unify governance toward transparent, centralized standards, much like we saw with the Malaysian model. They've got to proactively govern fintech, bringing AI and blockchain into the fold without breaking those ethical controls. And finally, investor education is key. By demystifying the system, they can prove its value to both Muslim and secular ethical investors alike. So I want to leave you with this thought as we look at the architecture of global finance. Are rigorous ethical constraints and asset-backed mandates a barrier to financial growth? Or, as we navigate an increasingly volatile world, are they actually the ultimate framework for market resilience? The data suggests that tying capital directly to real-world impact might just be the most stable engine we have. I hope this explainer has given you a powerful new perspective on how global capital flows. Keep learning, keep questioning, and I'll catch you in the next one.